There are so many middlemen in healthcare. This was frightening, but I think Fortune or a Forbes article, 45% of healthcare spend now goes to middlemen. Not to your provider, to the PBM, to the payer. Like, there's no way that's good. There is no way. And so I think a lot of Americans feel that. No one looks in their wallet and sees their Blue Cross card and gets warm and fuzzies.
And they say, and thank goodness that MultiPlan repriced this for me. Thank goodness. thank my lucky stars, right?
Welcome back to MasterMined. I'm your host, Mark Scrivner, and as always, I'm joined by my fabulous co-hosts, Jeff Skillen and Lee Pepper. Guys, welcome to the show.
Mark, it's always great to be here.
Yeah, happy to be here this morning in anticipation of this big snowstorm coming.
When the episode comes out, we will already have had Snowmageddon, but I'm sure...
So we should get LA's prediction now so that it's on the camera, locked in.
Yeah.
My prediction will be wrong, whatever it is.
Yeah. Well, I'm excited about today's episode. We're welcoming back a returning guest, L.A. Galyon of Brentwood Capital Advisors. L.A. recently attended the J.P. Morgan conference in San Francisco, one of the most important gatherings in financial and investment world. He's here to share firsthand insights on market segmentation, capital trends, and what leaders should be thinking about as we head towards 2026. L.A., welcome to the show, man. It's great to have you back. Thanks for coming in.
Thanks for having me back. It was a joy to be with you guys last time, and look forward to the discussion today.
Excellent.
Awesome.
All right, so Lee and I have been to J.P. Morgan. You just came back. So for those who have not attended, paint us a picture of what that actually is and what that looks like, and then what is that gathering all about?
So if you go back, the J.P. Morgan conference used to be the old Hamrick and Quist, which J.P. Morgan acquired in the 90s, and so it was historically a biotech pharma conference. Mm-hmm. It's morphed into the kind of start of the year healthcare kickoff for investors. So it's in San Francisco, which is one of the probably worst logistical places to have a conference.
Right.
People this year actually stayed in Palo Alto and Berkeley because the rates. I got my folio when I checked out, and the little Hyatt I stayed in was $1,100 a night.
Wow.
And so it's egregious what they charge. If you set the stage, the conference is about 8,000 people, but about 30 to 40,000 go out. The largest conference they have out there is the Salesforce conference, which is about 150,000.
Dreamforce, which, again, why continue to do it in a logistically terrible location? But that's what they do, right?
So, I think both those conferences are so important to the city. I have no inside information, but I would bet the city makes it worth the conference's time.
Yeah.
So it's there's definitely a financial arrangement there, but it is despite all that and despite the cost and this was not normal. The typical weather out there, like 2 years ago, this was the actual name of the storm, the Pineapple Express bomb cyclone. I ruined some loafers I had. It was sideways rain. It didn't matter if you had an umbrella. It was a disaster. And so most of the time when you schlep around there, you end up just like a wet dog.
Yeah.
At the end of the day, we had a couple of meeting spots this time, so we were able to be stationary, which was great. It's a good way to tease out of different investor groups. Folks in healthcare, the themes they see for the year. So despite all that, you do come back from it with a good toolkit of here are areas of interest, here are themes, not just sectors, but one of the biggest things we heard is tools, software, processes that make the providers efficient. Mm-hmm. There's a lot of investors who have shifted from we're going to invest in provider-based businesses. The PPM sector has really gotten out of favor to what are the picks and shovels we can sell to the providers. We want to make this behavioral company, this physician group, this surgery center more efficient. And there are all kinds of niches within that. So that was a big theme. Healthcare IT was a big theme. And then behavioral broadly, I think, was one of the few service sectors that was still in favor. That covers everything from facilities to outpatient to things like autism. So those were definitely in the strike zone for most investors.
When you say picks and shovels, obviously that implies gold rush. That implies California, all of those things. Is this still a gold rush? I mean, is that where we are right now in terms of money coming into our space?
So within behavioral, it's still nascent. So we talked about this last time, most of the sectors within behavioral have been covered in the last 20 years. The first state to cover autism was Indiana. That was 2007. If you look at the SUD space, even with the feds kind of pushing on some of the payers, it really was about 2013 until a lot of the payers recognized this. And then I think the states and feds have done a good job the last decade of really, I think the idea of covering these services is cheaper than not covering them. So most of mental health in the U.S. is, here's the ER. This is the place to go. Versus if you ask someone, hey, where's an outpatient place you can go for mental health? People have a hard time telling you.
I mean, we're still in what's an outpatient.
Yeah.
I mean, we're still in that world, right?
So having said all that, it sounds like that's the sector's in flux. We think it's in the batter's box of the first inning. There are more sectors within healthcare and in behavioral in particular, acute psych hospitals that are more mature. But there are tons of spaces where there's white space, capture the flag type of mentalities. How fast can you build it? And those are exciting to us. That is what you heard from investors. And I'll use the autism space as an example. There are very big, large-scaled autism platforms that are de novo based, all in network or Medicaid, that are 250 million of cash flow, like sizable businesses. And so to me, that means if you're in that sector, it's competitive. But you also see, hey, if you do this right, you can scale a business. There are other sectors that don't seem to scale. We talked about some of those a minute ago, like a silo of like one service line, let's say just detox. So, when you see larger companies and sectors that have scaled, that's usually a good signal the market's there.
Yeah, it was interesting. We just had Ward Blanchard, in from North Carolina. He's one of my clients, and they just got acquired by RC, Capital out of Cincinnati, and they're kind of interesting because Ward, he just has two outpatient locations there in Charlotte, and they seem to be really interested in expanding that one service line. It's kind of interesting. And when you were mentioning autism, I mean, are you seeing this consolidation where behavioral health, psych, and now autism, are there going to be companies that are going to be merging those all together?
No, I don't. They're very different, different patient bases. You don't see many, like on the adolescent side. You see businesses that are typically adult or adolescent. You don't see them mixed a lot. It's usually kind of their core competency. And I know I'm familiar with the Blanchard Institute. Great business, good guys. And I think the idea of this PHP and IOP business, if you look at what the payers are pushing in general, and I agree with what they're doing. A total knee, 10 years ago, replacement was a 3-day hospital stay. It's now a surgery center and you're out that day. And so the technology has gotten so much better. So if you can keep people out of facilities and treat them on a more longitudinal, long-term care, that's a better model than, hey, let's have an episode in a facility, discharge you back to where you're from, and then you're right back 6 months from now. So can you follow the patient longer, which is what autism does? I think ABA does a great job of that. Can you follow them longer on an outpatient basis, lower cost basis, and really get them back into society?
I was on a call, and sorry, Jeff and Mark, to hog this section, but I was on a call yesterday, and the person that was kind of pitching me kind of what they're doing in this space, they were not even saying the 30 days was treatment. They were referring to it as just 30 days of stabilization. Then we're going to move you into an outpatient and a virtual environment, which I thought was kind of interesting because maybe that sets the table for what really goes on, in your first 30 days of recovery anyway.
Well, and you guys probably remember this, but this is before I joined BCA, but in 2001, we represented Joey and Brent when reimbursement changed, in the psych hospital world. So before then, PSI, Psychiatric Solutions, they were managing, behavioral units of health systems. They had to pivot their model, at that point, and own psych hospitals. It was no longer they had to switch. So we raised capital from them to do that. They went public a year later. And if you remember in the 90s, Charter Behavior, all these businesses that did end up making it through, HCA closed their behavioral division. You used to have 30 to 40 day length of stays in the inpatient psych hospitals, and the reimbursement was cost based. You fast forward to today, the reimbursement, even 30 years later, is half of what it was in the 90s, and the length of stays anywhere from 6 to 8 days. And so I think you're going to see, just in general, that's not a behavioral only comment. you're going to see the payers just push things out of expensive areas and into lower cost areas. Most of these segments, and behavioral's no different, most of these segments can't prove, hey, if you give us this extra 10 days, the patient's going to be a lot better. There's not the data, and there won't be the data for a long time.
Right.
It's not like the outcomes. Everybody uses that word. What's that mean? The data, we don't have the data to prove.
But aren't we all evidence-based, LA?
It's like
Lee, this conversation is evidence.
it's like 10 years ago if we had a healthcare IT company and they said just put cloud in our name, we'll get 3 extra turns. And so there's all these words and buzzwords, the value base, that kind of stuff. It's in theory that sounds great, but it's when the Main Street or kind of real world examples, it's like, okay, how is this going to work? United's going to create all the rules, and they're going to pay you some magical bonus at the end of a year. I haven't seen that work with any, healthcare services companies yet, and nothing is scale.
Yeah.
Again, the value-based world, think about it this way. If I came in your office and said, I want to create a new commercial payer to compete against Aetna, Anthem, whatever, and I've got 10,000 lives, you would all laugh so hard your head would fall off at me. That's what these kind of at-risk businesses are doing. They're taking really small populations and trying to argue, we're making this huge change. And the payer's like, hey, I've got 30 million lives.
Right.
Yeah.
That's right.
You got 5,000?
Yeah.
It doesn't move the needle.
It's let's just stay on that tangent for just a moment, because we do talk to a lot of people, of course, that are pushing outcomes. They're pushing their own tools for outcomes. And it's like, and I agree with you that it's like, for whatever reason, it's like the outcomes tools that we have not moved the needle with the payers. So are you seeing that? Is there anything on the horizon that will address that? Or do you think we're just in never, never land for a while?
The holy grail, and a lot of larger scale providers would tell you this, this is what different sector, but if you look at like orthopedics, TOA would try to do this across the state where they did this not merger, but kind of this MSO. The holy grail is to be able to go to large employers, that are already paying. The payer is just administrating those benefits. Right. So they're not at risk.
We're talking about large self-insured employers. Yeah.
To go to the FedExes or Vanderbilt universities or these people and say, hey, give us your volume, and we're gonna charge you a cash price that's a fraction of whatever. It's, you guys have seen this with the PBMs.
Right.
There are so many middlemen in healthcare. This was frightening, but I think Fortune or a Forbes article, 45% of healthcare spend now goes to middlemen. Not to your provider, to the PBM, to the payer. Like, there's no way that's good. There is no way. And so I think a lot of Americans feel that. No one looks in their wallet and sees their Blue Cross card and gets warm and fuzzies.
And they say, and thank goodness that MultiPlan repriced this for me. Thank goodness. thank my lucky stars, right?
We all of us do healthcare. If you got your EOB at home from someone in your family was in the hospital and they got discharged, following that is like nearly impossible. And so to think that you're going to disrupt that from like a value-based, the payer has so much more information and leverage. And again, they're the ones making the rules and making the payments. It should absolutely work that way. You should pay for value and outcomes. It's the same thing like if you think about a kid going to college. What's your ability to place my child in a job? The university be priced differently based on their success rates. They shouldn't all be the same. But healthcare, disrupting that middle layer is so difficult because they have so much market power.
Do you mind if we just stay on this for a moment? Because I think this is really, really interesting. So I've said all along that, value-based coming from the provider side is kind of like the lotus flower that we're all waiting for to bloom, and we'll probably never bloom in our lifetimes, right? What I'm hearing you say is that we really got this backwards. We really need to turn the telescope the other way and just say that, you know what? The reality of it is, in terms of value-based, it's going to come from the payers. Is that what you're saying, or am I missing it?
I think it's going to be, so the value-based piece disrupts the payers. They are doing well in the current environment.
So one level up, we need to go actually to the subscriber or the employers.
Yeah, if you like, again, I use the example because I think they're trying to do it. But like the TOA example, like trying to get around that payer, that middleman, and go right to the person who's paying the bills.
Got it. Yeah, the shift that I needed to make, and you just helped me make it, is like, for a lot of providers out there, the payer is the end result. But I think we need to recognize that payer is an administrator. Mm-hmm. You know, it's like what we need to see is that ultimately that pool of subscribers or that self-insured business, that's ultimately where that's going to happen.
Yeah, the people who are paying the bills, who are self-insured, they're going to care, regardless who the payer is. They could be on United 1 year and Blue Cross 2 years later. They care that their employees are healthy. Mm-hmm. I think the provider who's seeing that patient cares that they're healthy, but there's a lot of people in the ecosystem who don't have that same incentive.
Yeah, I was really fortunate to work with a program that had pretty robust railroad contracts, and it's like, and we saw that regularly, where it's
EAP programs,
100%, and so. What was really interesting about that was, I mean, you were absolutely not discussing anything with the payer. I mean, those railroads were basically like, here's what's going to happen, here's what, and they dictated care. Mm-hmm. And then it was just like, and then, that insurance company, they just wrote the check. That's all they did.
Pilots, same thing, right? To be, if it's in the behavioral world, trying to get themselves back on their feet so they can do their job.
Right.
Mm-hmm. The airline actually cares that care is efficient.
Yep.
And so like we've disintermediated the two key people at the table, who are the employer and the patient, with a bunch of people in the middle of them.
So does that shift, or do we just continue to just kind of dance around?
It's tough. Really, if you think about lobbies in Washington, the payer lobby is probably the strongest.
Yeah.
Pharma's close behind.
Yep.
Providers are just, and the mental health behavioral is, nothing compared to those. I mean, just look at the dollars. Mm-hmm. You've seen a lot of the Senator Kennedy, get in front of, or Secretary Kennedy getting in front of Congress, and they're yelling at each other who the pharma companies have bought.
Right.
So just that's prevalent. I think where the hospitals have, a good stake is in most markets. Like I would think Vanderbilt Hospital is probably the largest employer in Nashville. In most markets in the U.S., the hospital is the largest employer. Maybe the school system. So most of those senators, Congress people recognize the importance of those facilities in their market. So the hospital definitely is at the table, but it's the secondary, tertiary providers that don't have a voice. We've seen it a long time. We do a lot of post-acute work for care delivered in the home, and their lobby has been weak and ineffective over time, but they deliver care for a third the price that a nursing home does. So again, that's where care should be moved into lower cost settings where it's still efficient, it's still the same level of care, but it's not in a facilities-based environment.
Yeah. LA, I can't imagine the amount of conversations you were involved in while you were out in San Francisco. But was there like a conversation or a moment or even an announcement that happened out there that maybe crystallized the sentiment of 2026 and the economic environment?
I think it's been a very difficult environment for private equity in general. The last 3 years, this was kind of interesting to me. It made me feel old. But if you were in private equity from 2000 to 2020, we will look back years from now. That was a golden age. Low rates, all that kind of stuff. That when you hit the summer of 22, man, that shifted.
Interest rates,
inflation,
yep.
Staffing costs, all the above were hard. I would say most of the PE firms we met with were like, gosh, we hope that this is the year that finally kind of turns the corner, because everyone's said that every year. So it wasn't as much of a theme. I think everyone is ready for the market to be not gangbusters, but normal. Mm-hmm. I saw the stat the other day that private equities delivered the last 3 years about a 5.8% return, and the S&P was 11%.
Mm-hmm. Yep.
So if you're a big endowment pension plan, you've paid a lot of fees into that end market. Doesn't matter if it's someone buying companies, a real estate business. You've not had much come back from it.
Right.
So the pressure on that world is intense. It was palpable. You could tell. Mm-hmm. So people are ready to do things. We've already seen some private deals that have happened that we kind of like scratched our head over that got done, especially in our world. And so that lets me know that purse strings a little looser. If you look at private credit, which is the lubricant for private equity, I forget the dollars amount, but it's like $1 trillion of dry powder in that world. And then private equity, when you combine that's like $3 trillion. that money has to be spent. It can't be returned. And so the private credit groups that are out there, and there's tons of stuff in the journal about this, there's been so much money raised.
Right.
And to me, that gets to the point. We tell clients, a lot of our clients are founders and family-owned or physician-owned businesses. Money's a commodity. Let's find the right partner for you all, because most of the time our clients are selling a portion of their business, not all of it. And so who they partner with is critical to get the business in the best place when they want to sell it 5 or 10 years down the road. So I think the one thing I would say is hopeful, optimistic, but I do think that this year is going to be a good year.
Yeah. Anything that surprised you, like while you're out there?
I mentioned this, feeling old. How many of the cohort of my friends who were kind of late 40s to 50s who have retired in private? I mean, like they had that 20-year run, which was just, and so many of these guys that I know well are now operating advisors. I was like, he's 52. What in the world? And so the other thing, the people that came to meet with us from these firms were young. Most of they sent a very smart, but they sent a 30-year-old to meet with our client. And so we're the 6 of us and a 30-year-old. And so that was pretty telling across the board. But I think that cohort of private equity executives from that 20-year window did really, really well. And they probably see like, hey, this is going to be really tough.
Right. They've hit the eject button, and then they're like, okay, we're going to let somebody else figure out this next phase.
Right? Oh, there was one firm I was like, where is he? And they're like, he moved to France. I'm like, oh, okay.
like you do.
I'm staying at the Fisherman's Wharf Hyatt. But it's that was, and again, that's natural for the younger generation to take over. But a lot of private equity, I think this is what got them in trouble. They get their talking points from some of the big consulting firms. They have so many resources, so they're going to get the best and brightest to come tell them. Versus, I think the Warren Buffett approach, which is roll your sleeves up, do your research, find the spaces you like, and it may be contrarian, but don't do what everyone else is doing. That's a sure way to a average to below return.
Well, we've been talking about looking forward to 26. I mean, obviously January kind of marks the end of 25 and the beginning of 26. How did 25 end up? And it's like, there's the market in general, but then, for you and Brentwood Capital, how was it for you?
It was a good year. It was actually our second best year on record. So that was really fun.
Congratulations.
Well, first half of the year, slow. Second half of the year, sentiment changed. We had, I would say even down to our analysts, the processes we ran from 22 through 25, they were just brutal. Buyers would bail really quickly on things. And so if you'll talk to tons of private equity firms, hey, we haven't bought anything in 2 years. Very, very common. Well, they hadn't sold anything either.
Right, exactly.
So the market's tough.
It's just kind of frozen, right?
Frozen. It's almost like they're afraid. The inertia of moving again is like terrifying. And then you had last 3 years, you had a huge delta between buyers and sellers. The buyers are saying, well, the business is now worth this. Well, I guarantee you they wouldn't say the same thing about their portfolio.
Right.
And so there was a huge delta. And it was very hard to bridge. And so there was a lot of things. We're proud of our closure rate over time at the firm is like 70 to 80%. It's not perfect. But the investment banking average closure rate is 40%. So think about that. Half the stuff you take to market does not trade for whatever reason. We think the average closure rate the last 3 years has been kind of in that 10 to 30% range. So that many deals have gone to market, and how many of them actually were successful in what they wanted to do. There's a variety of factors why that happens.
Right.
But the second half of the year, we have 2 deals closing, one tomorrow morning, one next week. We've now had buyers and processes be really aggressive. Like, hey, we love this. This fits perfectly with us. We want to take this off the table. We're going to do all our work before bids are due. So,
buyers in particular. So you're seeing more action on the buy side?
We're selling a company and a buyer in the process says, I'm going to buy this.
Yeah.
I'm going to win. I'm going to do all my work. When LOIs show up, I will be done. We had a client this summer we co-advised on. Liberation Day was not fun in March. But they had 3 groups who were just kind of, hey, we followed the company for a long time. We want to move quickly. And one of them was able to, from the time they said, we need 3 weeks of exclusivity, and they closed almost a $500 million deal in 3 weeks. Did all their work, all the purchase agreement, everything. So think about all the work streams that have to happen.
Yeah, it's incredible.
That didn't happen 2 years ago. We had a business. We announced a company we sold or recapped outside of Atlanta called Georgia Recovery Center. Same thing. We had a group. We had a bunch of groups and we were about to run a process. And the group that ended up winning said, we want to be able to give the owner at least what we're willing to do early. It's always up to the owner. He can say no. And so they gave us something. He goes, can I still run a process if this doesn't go? We're like, yeah, we're ready to go. QV, book, everything's ready. And those guys did a fabulous job, kind of in and out of the market in 45 days. Gave him a price that we viewed as a premium to market, and they were fantastic. But it was a buyer who said, I'm going to close this. That has not been the sentiment. And those are all second half of the year.
That goes back to the Buffett comment that you made, that it's like, the smart buyers are really narrowing the aperture in terms of what they're really seeking. And they've made some decisions in terms of where we want to focus. And then those that are getting in and getting something done, as opposed to this sort of generalist approach that said, we could just ride the larger wave.
There's a couple of quotes. So my partner, Tom Wiley, was at J.C. Bradford, I guess for 21 years before they sold. And he said, Jimmy Bradford used to always say, and I love this quote, he said, bought right is half sold. So if you are like that applies to a house.
That's right.
Too.
Yeah, I always, similar to what I heard is you make money when you buy.
Yep. So he's like, if you buy it right on the front end, you're halfway home to a sale. And what I'll give you a good example. And this everyone will know what this sector is. I don't cover the sector, but data centers. You see everything with AI, all this kind of stuff. A friend of mine in private equity in New York said he got a book the other day, and there's a lot of those in the market. He said. The banker said that the deal had 140 IOIs, indications of interest. That's the initial first round of a process. 140.
Wow.
That means there's going to be someone really stupid in the process who's going to do something really dumb.
There's not 140 great.
No, there's no return.
Right.
Versus if you do your research and you have a sector that hey, it may be off the fairway for most investors, but you know what to do with it, and you buy it right on the front where the seller gets something fair, but the buyer gets a great entry price and they know they can grow through it. We sold a non-healthcare business this summer, and I would tell you just the investor and our client that rolled equity, they have a path to a really great return just by working together. It's you don't have to hit grand slams constantly to win. They can hit a double and have a fantastic return. And those tend to be great deals, but and as a banker, you want to have sectors like the AI or data because those are easy to sell, but they're super competitive as a banker to get.
Right.
And from a buyer standpoint, it's almost like you should just opt out. There's no chance in the world. You win, you're not going to. You win, you lose.
Not only that, but I think that on the buyer side, you've got to think that they're getting so much pressure from the external investors to say, well, why aren't we in that? Well, it's because it's like that's what everybody's talking about, and they can't imagine not being in that fight, even though they might realize that it's not a great place for us to be.
When I was at a larger Wall Street firm before I moved back to Nashville and joined Brentwood. And it was fascinating to see what the guys well above me invested in. They were doing clean and green energy and solar stuff in the 2000, 2010 time frame. Well, they were harvesting it when all of that kind of green transition started. And they're like, there's no math that supports these valuations. It's too many people trying to do the same thing at the same time. We're sellers.
Yeah.
And they didn't dislike the businesses they owned, but they were 10 years ahead of the trend. And that's the hardest thing to do. If you're going to get a great return and be a disruptor, typically you're way ahead of the market.
I was going to ask, LA, just reading that, Debbie Osteen is now coming back into Acadia. Rob Wagner's come back into Promises. Is this signaling that some of these larger firms are getting back maybe into buying and getting more involved in buying some of these smaller programs again?
Well, I'm fans of both of theirs. It's been hard to watch the Acadia stock. And a lot of those things were that happened, some of those judgments that went against them would defy logic. I mean, again, not saying what happened was bad, but like if you look at the liability versus the revenue you're producing, like, well, no one's going to have RTCs in these states anymore because the liabilities, 10x the revenue. You can't even insure against it. So that was hard, but she's very good organizationally. She knows what she's doing. I think she'll bring some stability. Fan of Rob's as well. A lot of it is, and I don't have any. I mean, obviously, Acadia is public. I don't have any insight into promises, but a lot of what you've seen the last 5 years with interest rates going up is how healthy is someone's balance sheet and what's their ability to do transactions. There are a lot of companies, and our job, if you guys were clients of ours, is to tell you, hey, we're not going to show this deal to 5 firms. Like, why not? Well, because they can't do it. Like, we're not going to give your information to someone who they're going to use your information for something we don't want.
Yeah.
And so we try to be prescriptive and protective of the client's data. Really, outside of, I would say, healthcare IT, the rest of healthcare services, people have been nursing their balance sheets back to health. And you, especially the public companies, you can go look. When they have it in a deal in 2 years, of course, their M&A guy will say, I'd love to see it. Well, are you actually going to do something?
Right.
And so we've seen historically private equity be pretty aggressive. You guys remember back in the day with UHS was super aggressive, and they've had their whole M&A office here closed. And so we don't see them as active at all.
Yeah, I didn't get a Christmas card from Rob Miner this year. I need to find out what.
Well, do you think this is the year where that starts to turn, or is it we don't know yet?
Selectively, they're definitely so in all the sectors we traffic in, they're public companies where anyone can go look at their balance sheets. But it is fascinating when we pitch against other bankers. A lot of people just have this massive list of buyers, and we kind of cut that quickly and just say, we know these groups really, really well. We think they're good people. There's no way in the world they're going to be able to do something with their balance sheet.
Right.
And a lot of times, I mean, even groups like Summit Behavioral, I mean, their debt is they have bonds, and so you can pull up, Moody's, S&P. These are just resources that you can pull up. Like, it's difficult for them. I mean, they bought a lot of stuff. They use debt for all of it.
Right.
I mean, the one in Nashville that most people know is like Community Health.
Right.
Community Health did that big dividend, bought HMA, and they've just never recovered from having $12 billion. I mean, they're 10 times levered.
That's right.
So all they're doing is selling assets, paying debt down, but they're selling assets below the leverage. It's very hard, and there've been a lot of good people there, but when you get kind of upside down on that, it's hard to, it takes time.
Is that formula going to change, or do you think we just have to kind of ride this out?
I don't think. I'm on the sell side. I don't think services businesses, I don't care if it's an HVAC or a car wash or a behavioral, I don't think services businesses should trade for 15 to 20 times EBITDA. I don't. There's no math that you can show me that says, hey, this is growing at 40%. I mean,
even a platform, even a multi-state platform, well run, all those things. Because we've got people listening right now. They're trying to figure out what direction they want to go. And it's like, I'm sure they're hanging on every word that you're saying. And you're like, okay, well, you can just give up on that 15. This 15 is never going to happen.
Look at, I think a good example would be, and we have a client that's similar to these guys, but look at LifeStance. They go public, the stock, they've had to do some subsequent offerings, and they're cash flow positive, and they're making money now. But the stock is probably down like 70% from the IPO. It should have never traded like a software business.
Yep.
They're good at what they do. It's a great company. There's a lot of positive things, but it's fundamentally mispriced.
I'm just going to make a point that's what good marketing can do for you.
That's right.
Well, Jeff, I was going to say, I think LA said it earlier. I mean, there's nothing wrong with a double. I think sometimes when I'm talking to people, they're looking for the grand slam, and I'm like, there's nothing wrong with a double.
Okay. Well, and the thing about it is, it's like, LA, you know better than anybody, but it's like, the people that we end up talking to, there's enough still in the ether where those multiples were double digits. I mean, it was like 10, 11, 12. And everybody thinks that it's like they can still expect that.
So the good math that we walk people through, and we try to defang this in a way where it's, people, when we present to a board, they're nervous, to kind of hear how they're valued and that kind of stuff. But, we always tell people, okay, go to your local bank and see what you can get from a debt. It's going to be low. The bank's going to be like, well, you guys got a personal guarantee. And so if they have that, then say, okay, a financial sponsor can probably borrow more than you can because they have wherewithal. And then as you get more scale, those numbers go up. We think with the way the debt markets have recovered, and they're better than they were 2 years ago, but we've probably pulled a turn or two off of price just off of leverage. Leveraging things 6 to 7 times, 8 times is not responsible. There's no CFO on the planet that wants to be like, hey, I'm counting pennies to pay my interest. I'm not talking about principal, paying interest.
Right. Yeah, that's right.
And so when you were paying 15 times for something, you have to have 7 or 8 turns of leverage. And where the lenders and private equity guys got in trouble, the 4-letter word, which is not 4 letters, but it's pro forma. Hey, here are these synergies that are going to be awesome. Well, guess what? Most of those things didn't work out. So, hey, we leveraged it 6 times. No, we're leveraged 10 times now. And so there's a bunch of balance sheets like that lenders and PE firms still know. So it doesn't mean that a business isn't valuable. It's just to get to 15 times, you need 8 turns of leverage.
So I don't want you to get the reputation of being L.A. Galyon dream crusher. I don't want that for you. Okay. What do you think is realistic? And I know that it's by sector and things like that, but part of what I would love for the audience to be able to take away from this episode is, first of all, let's do this in 2 parts. I would like them to be thinking about what could or should they be doing to build maximum value for what they have, but then also how should they be thinking about multiples? How should they be thinking about valuation?
So there's a handful of. I mean, you're talking about in behavioral.
Yeah.
So in behavioral, that's actually probably one of the higher price sectors within services. It probably is the highest. So if you look at, I think probably the most expensive sector for investors to invest in, they like it a lot, is autism. There are deals from 12 to 17 times that have happened in the last year. I think the fundamentals of that sector, it's ABA is a gold standard of treatment. So it's a lot of behaviorals still trial and error. Let's try this. Let's try this. With ABA, it's very you have a staffing model, you have a treatment model, and it's not uniform everywhere because there's still personalities at play, but it's stable.
Predictable.
It's more stable than most in markets.
Let me, again, I'm just thinking about the listeners out there. So for them to understand the difference between something that commands a 12 versus a 17, what I'm hearing is stability, predictability, repeatability.
The biggest thing I would say is sustainability. So,
and that's also with the payers,
exactly. Yeah. And so we always use the example for our young bankers, like, hey, does Jersey Mike's have pricing power? What can they charge for a sandwich, and what's their ability to increase that over time? Same thing with software. Same thing with a service. What we see, like in behavioral, for example, one thing that's a theme we've seen a lot is the VA. The VA, the CCN of the VA will pay a premium to get providers to offer care.
That's right.
But what they do over time is when there are more providers in that market, they just dial that rate back. It doesn't mean they're trying to hurt the provider, but a lot of times you'll see people, and I don't really care if the business is, I do care, but like if it's in network, out of network, whatever, cash pay, is that rate fair and sustainable? It gets back to that unit. Here's our revenue per unit. Here's our cost per unit. How many units can we do? What's the kind of overhead cost to do that? And so when you look at autism, it has got that in spades. It's treating kids for $70-$80 a visit. It's a one-on-one therapy. It's a huge supply demand imbalance. It's capture the flag. How many of these can we build?
And it's still early.
It's still early. I mean, there are probably 50 PE-backed platforms around the country, and they have learned. I always use this example too. I love food, but Starbucks. When Starbucks comes in a new town, do they buy the local coffee shop? No. They build their own. They have their own model. I think you're going to see that better in healthcare over time, where, hey, we know what we're doing. We don't have to buy this group. And so M&A and autism did not work. It imploded. And so you had a 2-year window. And so I think all the guys know, all the investors know now, like, hey, we got our model. We know exactly the square feet. We know our number of employees. We know the payer as well. They know we're going to take care of their patients. And so that's a good one. So but it's got the model figured out.
Got it.
Then you have more mature sectors on the other spectrum, not picking on it, but like hospitals. Just the liability associated with what you've seen, what Acadia has been through.
Acadia is a perfect example.
That terrifies investors. So Acadia and UHS, I think, control 50% of psych hospitals. Well, the ones they don't control, they know well, and there's a reason they didn't
There's
buy
a reason
it.
they didn't buy it. Exactly.
So that's a tougher. I would say it's not a bad. It's just more mature. And that goes for all of facilities-based healthcare. I mean, being a hospital operator is hard, and it takes a lot of money to do it, and so that runs counter to a good return. And so in the middle, because so many of these spaces are nascent, like outpatient mental health is top for most investors, area they want to be in. They can't find anything of scale.
Mm-hmm.
I mean, they can't find anything.
It's still disparate. It's still spread out. There's no consolidation.
So if you're XYZ PE firm and your minimum check size is $50 million, there are just not a lot of things out there.
Mm-hmm.
And then I think you mentioned marketing, clinical compliance. Those are things that are typically not done well. So when we help a company, typically it's, I wish it were shorter. The time we meet someone, the time we formally help them is 3 years. There's usually a bunch of stuff in the middle they need to do.
I think that's important for people to understand is, I mean, the life cycle of this, on average, they could be longer, they could be shorter, like you said earlier, but I mean, you're talking up to 3 years. We
had a prospect we were talking to in the behavioral side, and they had a governmental issue, and they were not equipped to deal with it. And it's probably going to end up not in a good place. It seems small to them. It's taking their census down. It's really tough. And so if you think about the scrutiny that a physician group, a surgery group, that they're under, apply that to anything in healthcare, and I think mental health behavioral is behind. There hadn't been the money. So most of the scale providers there are not many of them, that are larger, you have that. They have got that kind of healthcare background. Hey, we can't do this referral. We can't do the very ethical type folks that run them, and it's not that the other people aren't. They just don't know any better.
Mm-hmm.
That's the professionalization that has to happen to get the businesses at a scale where someone's going to pay that huge multiple for them.
Yep.
It's not there yet. There are a lot of businesses that we know that have gone to market that, that went dark. What happened? And they're like, well, it went on the path and it failed clinical diligence, documentation, or whatever it may be. So think about a DOJ or a CMS audit. Most mental health providers probably couldn't get them. They don't do Medicare a lot,
right?
But they probably couldn't get through one of those.
Yeah.
So it's just that, and again, picks and shovels, marketing, compliance, quality, all those things. There are outsourced providers that do that if they can't do it in house.
LA, I wanted to ask you, 'cause this question comes up a lot on our episodes. What do you think a fair percentage for marketing should be? And I always reference at Foundations, we were willing to spend 10% of net revenue on marketing. Am I still valid in saying that in today's world, or what do you see?
So we kind of look at that as in the corporate kind of veil, corporate cost, and until you get to north of 100 million in revenue, we see corporate cost anywhere from that kind of 10 to 15% of net revenue. That's and that could be rev cycle, marketing, all those types of things, compliance in there. When you look at field level, facility level, kind of cash flow, EBITDA margins, the business, for a business to be healthy, it needs to be in the kind of 30s, 30 to 40%. Then you can afford that 10 or 15% deduction to do the stuff you need to do.
Gotcha.
So we see companies a lot that outsource marketing to an SEO group or outsource their rev cycle, and as they get to a larger scale, they try to hey, can we do this more efficiently in house? But I would say that 10 to 15% is what we see.
It's kind of in the ballpark.
It's interesting that you mentioned outpatient because I feel like the folks that I have consulted with on the outpatient side, they just don't have enough to spend in marketing in the get-go. And so, there's nothing wrong with bootstrapping it, but I feel like that's one of these problems that we have, why we can't seem to find a platform that gets scale.
We have a client in the outpatient mental health space, and they're on the West Coast, and it's a really neat model. What they've done, they have bricks and mortar, so they've got double-digit number of locations, but they'll also work with independent providers, and they'll say, hey, Jeff Skillen's got his own clinical practice. We'll work with you, and it's all stark. It's all above boards. You keep your practice. We'll have a split where the payers send us a lot of patients. We don't have anybody in this market. And so we can share those patients with you. You keep the majority of the revenue. They do all the contracting, all that kind of stuff. And so that business,
That is a cool model.
it's a really cool model. And that business is scale. I was shocked last week. I was with them in San Francisco. I mean, they're seeing more than 30,000 patients a week now.
Wow.
But if it was just bricks and mortar all the time, you couldn't scale.
But is that going to impact their valuation when they have all of those independent arrangements?
It's definitely like the 1099 versus W-2 is a nuance for investors. But if let's just say you're going the W-2 route, and hey, we got to get a lease, we have working capital. Now we need to build up all these patients at this location. It's going to take us 18 months to break even. You're going to have some locations that do better, some that don't. And you'll go into markets where, hey, there's an established clinical community here. They don't want to be bought. And they don't want to work for someone else. Like, how can we partner with them where they keep their practice, they do a really good job, but we can bring some patients, know-how to the market where, hey, here's 500 new patients you didn't have before.
Yeah.
And the investor community is going to be okay with sort of this rent-to-own approach? I mean,
So it's a hybrid.
Yeah, right. Okay. No. So a portion I get. It's interesting because a lot of times, the investors are going to be like, well, if we can't own the whole thing.
So the payers want kind of full continuum. They want access. So I'm not a fan of tele only. Tele only typically in healthcare, those patients tend to be the least acute. There are patients who are willing to pay cash for whatever it is. I'm going to see a therapist every 2 months. They are not very different patient base than like the folks who are going to a Suboxone center, right? Those people are trying to get back on their feet, trying to get back to their job. Very different. And so what we like in healthcare and behavioral in particular is the hybrid. You have facilities. So you can do ketamine, TMS, those things in a facility if the payer needs it or the patient's acute enough where they need that. But you can also do talk therapy to them because they live 30 miles away from the nearest center. So I think you have to have both. And that's what we've seen. A friend of mine has 10 outpatient mental health centers in Texas. And he has basically discovered anyone under 35 doesn't want to come in. They want to
They would Zoom, though.
They would Zoom in with their therapist. They do not want to come to a facility. They'll do it frequently. And then we've got a client that's in the IOP space. He said people will share more, which I thought was interesting, on a virtual IOP visit, at home, than they will in person.
Interesting.
People kind of fold their arms and kind of look around and don't want to talk. But in their home, there's a comfort level there. And he said if they're under 40 and it's an IOP, because they're going to opt for virtual. So to have the ability to do both. So I think you need facilities because you're going to have patients that are acute enough where they need something in person.
Right.
But you also, to reach more patients, having partnerships, having tele, having the ability to reach them, they're not mutually exclusive. That to me seems like, and the businesses we've seen do that are growing really fast. So you're still going to have the W-2, 1099 issue, and they're going to be investors that can't get comfortable with that. I think if everyone was 1099 and you were all virtual, totally agree.
Forget it. Yeah.
But if you had a hybrid approach where like this is how we can get a foothold in a market, and the really good psychiatrists in that market may not want to sell, but how can they're really good?
Yeah.
How can we work with them?
Yeah. All right. So let's go after. So let's go back to the other part. 3 things that people who are listening to this podcast right now should be doing in 2026 to add value to their practice.
I think, there's always value in strategic planning and looking out, the business. And not every business needs to sell. Like we will tell, hey, if you have someone who can take over or someone you can hand it down to. But, sometimes businesses get to a plateau or get to a disruption point, or the owner wants to retire. It could be any combination of those. So what we try to tell them is, we're Switzerland. Think about us as a board. We're gonna think through like what makes sense for you. And forcing them to do that, most business owners haven't done that strategic planning. Where does the business need to be in a year, 3 years, 5 years? And most of them, I would tell you to a person, never thought the business would be big enough to matter. Like, oh gosh, we were just trying to make payroll. And now this is a $100 million company.
Yeah.
They never thought that. And so what we try to do throughout that process is get them to experts. It could be, like we have a client in California, and the way they were set up, where their entities was set up, who held the contract. It's a SUD provider, but they had contracts. We had to get them to a lawyer. And it took about a year to set up the entities. California's got all these penal change of control things now. to set up all these entities where they could do a transaction and not trigger like 80 different, we got to get approval from OSHA, got all these different things. We're not avoiding it. It's just, why would you put yourself through that?
Yeah.
So that took some time. And then on the financial planning side, we don't manage money, but hey, we're going to get you to someone who's really good at this. Let's lay out, like a lot of business owners will say, I need this price. Well, why? You're making this much money a year now. Let's actually do the math of what you need. And I guarantee you, it may be higher or lower, but like, let's actually have the math right. And then they're the experts around the sector. It could be marketing. It could be rev cycle. It could be different parts of compliance. And we don't get paid by any of these people. We want to plug them into good people and get out of the way. But typically, that's why we have that 3 years. They need those experts across the board to help them kind of force think through what are the important things for my business if I keep it or I don't. But none of them have done that planning.
So one, have the conversation about the end you have in mind.
Mm-hmm.
2, make sure the structure is in place that might support that.
Mm-hmm.
3, plug into an expert network that can help you where you need. So it's like when you need help, raise your hand. I need an expert.
It's a village to get these things to an outcome that the business owner is excited about. It is not just a banker. It is not just putting a book and model together. There are processes, systems. Most of our clients don't have on the management team anyone who's been through a process before. So when they get a 10-page data request list from a buyer and their lawyers, their head explodes. Like, where is this stuff?
Only 10 pages?
Oh my God. We give them a 3-pager. But it's a process of getting them, and think about a board, right? It's a process of getting a bunch of really good people around the table who are going to help them get to a good, healthy option and educate them on what their options are. We often tell people, hey, don't take our word for it. Ask 2 or 3 other experts in these fields and get as much feedback when we go through a bake-off with other banks. Like we tell, you're very smart to talk to 2 or 3 banks. Make sure you hire the right person, but talk to as many people. This is the most important financial decision you and your family will make. Do not take it lightly. Talk to folks on the marketing side. Talk to good lawyers, and you're going to come to a good conclusion. So we just try to arm them with as much information as possible. It's a very educational approach, and we're not the only ones talking to them. If we do that right, they'll be in a good spot.
LA, this has been such a great conversation, very insightful. Appreciate everything you brought to the show today. Is there anything, maybe as we wrap up, is there anything that we didn't ask you that you think might be helpful to the audience?
We had a bunch of good topics. I'd have to think through that one.
Well, let me throw in, because we wanted to ask, what conferences should our audience be thinking about for 2026?
So there's behavioral does a better job now. And forever, and you guys know this, I would go to conferences, and it was all like marketing people and clinicians like exchanging resumes. So like, this isn't helpful to me. I think I went to the one in Cape Cod one time. I'm like, what am I doing here?
But you love the foundations conferences, right?
Oh, those were great. Well, back in the day, those were the go-to.
They were the go-to conferences. For sure.
So there's a handful of conferences.
Sorry, Cape Cod.
No, but I love Cape Cod. I went to dinner every night.
Were there going to be? Aren't they in Provincetown this coming year?
I think so.
Yeah.
Anyway, go ahead.
And so with any conference, how much of the content, if you're a business owner or CEO, how much of the content there makes you want to go? There are continue ed type conferences, which is a lot of the stuff I went to. Very good for people in the field, but not really good for business owners. And so there, BHB, Behavioral Health Business, does a conference. It was here last year, Invest. I think it's in Scottsdale this year. It's in the fall. That's really well attended. A lot of good folks like yourselves and vendors in the sector, but most of the CEOs we know go.
No, I was very impressed with the attendance. It was really incredible.
We do. We work with a law firm that does an event in Nashville. It's May this year. It's the 20th and 21st, and there's an entire bespoke behavioral day. And so we just invited a lot of our clients, and that when we want our clients to meet each other, or folks in the sector, because they can compare notes like, hey, what have you been thinking about doing? What, that kind of stuff, and that'll help them as well. And then there's a conference in February called I'm probably mispronounce it, the BASE conference.
Yeah.
And that's in Miami or outside of Miami.
Yeah, it's in Miami.
And so that's been a good conference. That's coming up in, I guess, 3 or 4 weeks.
Mm-hmm.
But those are the ones that we see the business owners and CEOs or CFOs go to, so that those conferences make an impact on them versus just a general networking conference, which I don't think is value add.
Yeah.
I mean, one that we've been kind of talking up just because I'm super interested, not necessarily as perfect for you, but is the AI conference that's going to be in Nashville in April. I mean, it's just as disruptive as that is. It's like all the vendors and all the leaders in that space are going to be here. So we're excited about that one too.
We got that question a bunch. JP Morgan, is AI going to take over therapy? And I just think, like the liability associated. You guys saw this AI suicide situation, and so it went down several permutations where a person would eventually have empathy and be like, no, stop. And so, sometimes investors want to see everything digitized and computerized. That's not real, and there is like liability in these businesses. I mean, you're treating some people who are sick.
Well, we tried to do an AI avatar for Mark, and it failed, so we had to bring him back in person.
We are. I mean, to a certain extent, that conversation, we're kind of in silly season, just a little bit in that regard.
It's like that. You heard the term blockchain 5 years ago, and you heard cloud, 10 years ago, and so I do think that AI workflow tools will really help.
That's picks and shovels, man.
But you're not putting AI in Brentwood Capital's name. You're not renaming. Okay.
No.
You heard it here first.
There are for our business. I mean, think about accountants, lawyers, finance. There are things AI can do that historically have been just heavy lifts. Building a book, that kind of stuff. You still have humans doing that, and there's a repetitive part of that, but just the amount of think about a lawyer doing discovery, in litigation. How much can AI speed that up? And so we see that workflow as a benefit. So we're using a lot. But our business is still hand-to-hand combat. When we're dealing with a buyer in a deal, there's still that part.
Yeah, the thing that we say time and time again on this show is that this is a relationship business. And so it's like, LA, you know that better than anybody. Your side especially, but all the things that we do, that's not going to be replaced by, people are not going to want to work with an AI agent to develop relationships.
No, the relationship side of the business is still, the key. It is the crux of our business. I think in any business, you have to be credible and that's table stakes. That you can do the job that's being asked of you, but do people trust you? Are you sincere? Do they feel that you have their best interest? And if those line up, we're in good shape.
Mm-hmm. Yeah, it is amazing how I've talked to you many times about how long it takes for you to get through the process with programs and how you stay with them and advise them, and it's very admirable. So.
But it's also the joy. It's the fun part. You follow a person for a long time. You invest in that relationship. You get to see them succeed. That's really fun.
Yeah. Well, thanks again, man. And thank you all for joining us today. That's a wrap for this episode of MasterMined. On behalf of Lee, Jeff, and the entire MasterMined crew, I want to thank you for being a part of the show. If today's show sparked any ideas on capital or conferences or anything that LA spoke about, please drop some questions in the comments section, and we'll be sure to get them over to LA and get them answered for you. Please remember to rate, review, and subscribe to MasterMined so that we can get this show out in front of more people that could use the help. So thank you. We'll see you next week on MasterMined.
That wraps up this episode of MasterMined. Thank you so much for joining us. And remember, MasterMined is not just a podcast, it's a community. So don't forget to comment, subscribe, and review us. Your feedback helps us continue to bring you content that's relevant and relatable. Thanks again to our sponsor, Snapshot, a digital media marketing agency. And thank you for joining us on MasterMined, your behavioral health playbook.